This is part 2 of a very in-depth market analysis heading into next week, and if you missed part 1, I've linked it above. As always, nothing that I share is financial advice, and you should always seek a licensed financial advisor before making any financial decisions. Kicking things off with Dixie, the dollar strength index. The market hates volatility in dollar strength, and we can see how the dollar selling off corresponded with the initial sell-off in the markets back in March. Then it stabilized for a few weeks and consolidated. I took a measured move of the initial leg down and I dragged it over here in yellow. And I had shared that if this actually was like a giant bear flag, the Dixie was still headed down to about 100.44. So what actually happened here? We can see that in extended hours, Dixie started heading back down. Then Friday morning, the non-farm payrolls numbers came out and showed that the U.S. added a whopping 228,000 jobs in March versus the 137,000 expected. And then later in the day, Jay Powell indicated the Fed was in no hurry to cut rates until they saw more hard data to show that the labor market was deteriorating. And this is why it's so important not just to look at the technicals, but also you have to have a way to stay updated on key economic numbers, breaking news, and earnings reports, because ultimately the technicals are a reflection of what the market believes, aka the market narrative or sentiment. One thing we can't rule out if Dixie decides to start dropping again is a repeat of the yen carry trade blowout like what led to the August 5th, 2024 crash. And notice on the 1 hour time frame how Dixie appears to be forming this bearish rising wedge pattern right up into this resistance area. And if we take a measured move and we drag this over, we can see that Dixie would be going back down to target basically this key level of about 102 even, give or take. On Friday, we saw something that is extremely rare on the ADD market breadth indicator, namely that the ADD held and closed below the minus 2,000 level. This thing closed at negative 2,300. To show just how rare that is, the last time that it actually closed below that minus 2,000 level was at August 5th of 2024. And we know that that marked the local bottom before we saw a rally that ensued. We'll keep looking left. The one thing that I want you to notice that is most important is that virtually every time that the market as a whole got this extremely oversold, it was followed by a bounce. As we've been covering, the descending triangle pattern on the VIX indicated that it could go to roughly 67, pushing right up into the supply zone and basically hitting this ascending resistance line here in purple that goes back all the way to July of 2023. It's currently around 45, so that would be roughly another 49% up if this actually plays out fully. The VIX is also well over the multi-year resistance line that goes back to January of 2022. And on the VIX futures, it clearly goes all the way back to March of 2020. While we're looking at the futures, notice how the pattern target for this very clear falling wedge pattern is only about halfway complete, and it's targeting roughly 76. Quickly switching over to the option chart for the VIX. If you're unfamiliar with options, there's something called option skew, and that's basically when the premium for one side, puts or calls, is noticeably higher than the other. Most of the time, the price for an at-the-money option would be pretty close. We can see how the puts are going for about 10 times the amount that the calls are for the May 7th expiration. Ultimately, even as much as we've sold down in the market, it was all pretty well-controlled selling, and so we never got that VIX spike that I was looking and kind of hoping for. I legit feel like VIX call buyers got screwed this time. And the last time that the VIX spiked to over 60, the VIX 40 calls went to about $700 a piece, and the VIX 20 calls went to roughly $1,700 a piece. And the VIX is at 45, and these contracts are only going for about $180 to $200 a piece. I'm holding out hope that we still see that massive VIX spike and I can sell my runners. With that said, the second that the VIX starts crushing, as it always does, IV on all options in the market is likely going to crush rapidly, and regardless of whether or not the market goes in your direction, you could potentially still lose money if IV drops low enough, which is something that is very important to keep in mind. Me personally, I would not want to buy options until volatility comes down substantially, and although it is very risky, option sellers are likely to profit in this kind of environment so long as the market doesn't go against them. SOXL for semiconductors broke convincingly below this main support line that had held up since November of 2012. We can see pretty clearly here that it formed a double top on the monthly time frame with bearish RSI divergence for confluence. On the weekly time frame, it also broke below this support line in orange that had held up since October of 2022. On the 4-hour, SOXL was forming this bullish falling wedge right here until all this tariff news came out, just like what I shared on SPY and QQQ. And if you missed the first half of this analysis, don't forget to check out that video because this all ties together. If we take a measured move from this roughly 3260 level down to the bottom support line about 1960, that gives us a measured move of roughly 13 points. From the breakdown of the lower support line of this pattern around 14, that would indicate that SOXL is headed to roughly 1 even. Yes, you heard that right. The last time that SOXL saw that price was February of 2016. The pattern took about 47 days to set up, so it could theoretically play out within about 15 to 16 days, or Friday, April 25th. And it blows my mind how all of these dates appear to be lining up. I shared in last week's analysis that a conservative target for when the VIX could hit about 60 plus would be near the end of April. On SMH, you have this main support line in green that goes all the way back to February of 2016. And now notice how you have this very well-defined rising wedge pattern here in yellow. From where we actually broke down, this is targeting roughly about $144, which is very close to that main support line. Just like we saw on multiple other tickers, SMH was forming this bullish falling wedge pattern on the 4-hour time frame, but it broke below support on Friday, and if this plays out to the downside instead, it's targeting roughly 157. So you've got two different patterns both saying that this should head lower. If we get down there, it would meet up with the convergence of this key support level and the main ascending support line around 140, which is also a key psychological level. And if that support held at that level, it could be an amazing buying opportunity. Looking at GLD for gold, I pointed out a few videos ago how close GLD was getting to touching the upper resistance line of this long-running bullish channel in orange, and that once it did, it was likely to reject sharply. Isn't it interesting that even though it pierced for a few days, by the 4th day it was selling off sharply? And I could see gold retesting its previous resistance somewhere around 272 and possibly getting a bounce from there. And if that doesn't act as support, it'll likely retest previous levels on the way down, which were basically about 266 and 261, and may even try to retest the lower support line of the bullish channel, which would be around 258, which also happens to be a very key level and one that sent GLD falling rapidly back in October of 2024, which if we zoom out a little bit, you can see right here. If support holds up there, I could see it being an excellent place to load up longs. Silver has absolutely tanked, especially as the dollar begins strengthening on Friday. Silver is used in industrial production much more than gold, so if the markets are pricing in a recession, that could absolutely be why it's tanking. There don't appear to be any clear patterns setting up, so we really only have key levels to go by. If it gets down to roughly 26 even, I would expect to see a bounce there, and if it starts pushing back up, I would expect there to be strong resistance around basically 27.30 and then 28 even here. But just eyeballing it, that $28 level kind of looks like it would end up being about the 50% retracement of this move down. Copper is a strong indicator of global demand, and it's why it's often referred to as Dr. Copper. Taking a look at COPX on the weekly time frame, notice how there's this well-defined ascending triangle pattern. and we broke convincingly below the support line this past week. On the monthly time frame, the RSI is already oversold, and COPX is retesting this previous support around 32 even. It may try to go back up and retest this previous support line around 39, or it may continue to keep moving down and try to test this demand zone between about 24.75 and 29. If this pattern plays out fully, it indicates that COPX is headed to about 1530, which lines up almost perfectly with the support line here in orange. And it's only really ever been that low back in about 2016 and 2020. It would have to break through support around 2250 and then this very strong support level around 18 even. But what it indicates though, and this is not meant to instill fear, but we could be headed to a global economic slowdown as many have been warning for years. This pattern took 47 months to form, so a conservative timeline for when this could play out would be about a third of that, or roughly 15 and a half months, which is actually a reasonable amount of time for how long recessions can last. And that would indicate that COPX should hit a bottom by about late June or early July of 2026. Mark this video and see if that doesn't play out. I hope it doesn't. Looking at crude oil futures, I really hope that this pattern does not play out. I hope it's not real. My charts are always on log scale, and if this pattern plays out, the measured move from this breakdown here has this going roughly down to 1. Yes, you heard that, 1. Now I'll quickly switch over to linear scale just so you can see where that pattern target is targeting. That would obviously place it below the pandemic low of 6.5, and I don't even want to imagine what would have happened to the world if oil ever gets that low. That would essentially mean that there was zero demand for oil, and yet the pattern is here. This pattern took roughly 41 months to form, indicating it could conservatively play out in about 13 and a half months, or by late March or early April of 2026, and I'm praying it doesn't. So at the end of all this analysis, what does it appear that the market could be telling us? Well, I can say this is one time I pray and hope the technicals are wrong, even though they usually aren't on these higher time frames. This all appears to be telling us that things could definitely get worse before they get better. And this is not meant to incite fear. And frankly, if these patterns play out and we have measured moves and timelines, we will know when the true bottom is likely in. And there will be counter trend moves along the way. I don't believe we're likely to see all-time highs again for a while, but I could be absolutely wrong. If news comes out that tariffs are lifted on our major trading partners, if Russia comes to a peace deal, etc., market sentiment could shift rapidly and lead to a very sizable short squeeze. Stocks are at much more attractive prices than they were before, but I'm keeping in mind that they could get even more attractive. If you're in for a long-term hold, you might end up with a once-in-a-decades buying opportunity. Next week, we have some very important economic data coming out, including FOMC meeting minutes on Wednesday at 2 p.m., CPI and initial jobless claims on Thursday at 8:30 a.m., and PPI on Friday at 8:30 a.m. And I get all of this from investing.com's economic calendar, which is totally free. And also on Friday, we've got earnings for JP Morgan and BlackRock out before the bell, which could both be market moving. And I absolutely love Moomoo's earnings calendar, as well as their accurate charts and numerous other features. And I've found them to be a pretty reliable platform, although I don't trade on it currently. So if you're interested in opening an account with them, please consider using my referral code, which I've placed in the video description. And if you deposit at least $100, we both get rewards, which can include up to 60 free stocks. Best of luck, cool cats. God bless, and please stay safe.